Computing yield to maturity. We know that yield to maturity is the rate implied by the current bond price. We can do that. We can calculate yield to maturity using financial calculator or trial and error method. YTM with annual coupons. Consider a bond with 10% annual coupon rate, 15 years to maturity, and a par value of 1000. The current price is 928.09. So here your coupon rate is given, maturity period is given, par value or face value is given, and bond price is also given. So now we have to find out the YTM, and either it more or less than 10%. So using financial calculator, press maturity period 15 for n is the number of period, and bond price is the present value of bond. So press 928.09 for present value. Since it is investment, we know that always investment is cash outflow, so it should be negative. And press 1000 for future value or face value. Press 100 or coupon payment for PMT. So here your coupon percentage is 10%. So 10% on 1000 is 100. So your PMT or periodic payment or coupon payment is 100. Then press CPT interest, which is 11%. So here we get our YTM is 11%. Yes, it is more than 10%. YTM with semi-annual coupons. Suppose a bond with 10% coupon rate and semi-annual coupons has a face value of $1,000, 20 years to maturity, and is selling for 1,197.93. So here your coupon rate is 10% and it is semi-annual. And face value is 1000 and 20 years is the maturity period and is selling for 1197.93. It is your bond price. So here your bond price is higher than your face value. Is the YTM more or less than 10%? We have to find this out. What is the semi-annual coupon payment? We can also find it. Our semi-annual coupon payment is, since it is semi-annual, then our yearly coupon payment is 10% divided by semi-annually is 2. So our semi-annual coupon payment is, coupon percentage is 5. So 5 on face value 1000 is 50. So our semi-annual coupon payment is 50. How many periods are there? Since it is semi-annually, so we have to multiply 20 years with 2. So our total period is 40. We can do this using financial calculator. We know that our total period is 40. So press 40 for n. Then our bond price is 1197.93, which is for present value. Then our semi-annual coupon payment or periodic payment is 50. Then press 50 for PMT. Our face value is 1000. Then press 1000 for face value. Then press CPT I divided by Y, which is interest rate, which is 4%. So now question is just, is this YTM? No, it is not. It is semi-annual YTM. So our yearly YTM is 4% into 2, 8%. We have already learned that when YTM is less than coupon rate, then bond price is higher than face value. So here you can see that our YTM is 8%, which is less than 10% coupon rate. So in that case, our bond price is 1197.93, which is higher than 1000. So it is premium bond. In premium bond, only the coupon payment is the main profit for the investor. Current yield versus YTM. Current yield is the annual coupon divided by price. Current yield considers only the coupon portion of your return. It does not consider the built-in gain from the price. Built-in gain from the price discount. For a premium bond, the reverse is true, meaning that current yield would be higher because it ignores built-in loss. Again, we can say that current yield considers only the coupon portion of your return. It does not consider built-in gain from the price discount. And here we can also see that current yield formula is annual coupon divided by price. Yield to maturity is the current yield price, current yield plus capital gains yield. Through an example, we can find this current yield. Example, 10% coupon bond. Coupon rate is 10% with semi-annual coupons, face value of 1000, 20 years to maturity, bond price is 1197.93. So here your current yield is 100, 10% on 1000, which is annual coupon, divided by bond price 1197.93. You can also raise question that why coupon rate is 100. You can see that it is mentioned as annual coupon, not only coupon. If it is mentioned only coupon, then as per semi-annually, the current rate would be 50. Since it is annual coupon, that is why the full coupon payment is mentioned here. So here your current yield is 8.35%. We can assume that after 1 year the bond price decreases at 1193.68. So we can find the capital gain. Price after 1 year is bond price now is 1097.93. After 1 year we can assume it 1193.68. So the after 1 year bond minus the current year bond divided by current year bond, then we get capital gain yield 0.35%. So as per yield to maturity formula, current yield plus capital gains yield. Since your capital gain yield is negative, then 8.35 current yield minus capital gain yield 0.35 negative, where your YTM is 8%. This way you can calculate your YTM and current yield from current yield. Bond indenture. Bond indenture is the contract between the company and the bondholders. When the bondholder issue bond, when corporations or government issue bonds, on that time, the bondholder and investor make some specific agreement and which the both party have to follow. So all these conditions, all these agreements are written in the bond indenture. So what is written? The basic term of the bonds. First one is basic term of the bonds. So how much should be the bond value? Uh, what is should be the coupon rate? The all things should be mentioned in the basic term of the bonds. Then total amount of the bond issued. Normally corporate bond is $1,000. So if you issue $1 million equivalent bond, so your number of total bond will be 1,000. So 1,000 bond at the rate of $1,000. It should also be mentioned in the bond indenture. Then a description of property used as security. Since it is uh, dead, then there must have some security uh, for the investor security purpose. There must have some collateral. Sinking fund provisions. Sinking fund is the some amount that is setting aside that is setting aside for the periodic repayment of loan. Like the bondholder can keep some fund in setting aside in for the repayment of their face value of bond. It is also like loan amortization to decrease the bond value. Call provisions. Call provisions actually it is about the conversion of bond in common stock. A call provision allows the company to repurchase or call part or all of the bond issue at stated price over a specified period. In call provision, a company can call their bond back, and in call provision, the bond value is normally higher. Details of protective covenant. It is a part of the indenture that limit certain actions that might be taken during the term of the loan, usually to protect the lender's interest. In protective covenant it mentions that how much dividend should be paid, how much return earnings should be kept by the company. All these things are uh, mentioned in the protective covenants in order to ensure the lender's maximum interest. Bond classification. Registered versus BRR forms. A registered bond is a debt instrument whose bondholders' information is kept on record with the issuing party. By archiving the owner's name, address, and other deals, issuers ensure they are making the bond's coupon payment to the correct person. Unlike registered bonds, bearer bonds contains no owner information whatsoever. Consequently, bearer bonds will issue coupon payments or will repay the principal amounts to whoever is in physical possession of the certificate. A bearer bondholder simply must cut the coupons attached to the bond certificate and present them for payment. This is the reason bond interest payments are commonly referred to as coupon. Obviously, bearer bonds are much less secure than registered bonds. Lost or stolen bearer bonds cannot be replaced, as no records exist on the owner's identities. Based on the security, bond can also be classified. In security, you can see security can be collateral, mortgage, debentures, notes. Collateral is the collateral is secured by financial securities. Mortgage is secured by real property, normally land or buildings. Debentures are like period interest payment or coupon payment, which is unsecured. If business is not going good, the interest payment or coupon payment may be disrupted. Due to interest rate changes, it can also be disrupted. Notes are also unsecured debt, which originally matures less than 10 years. Based on seniority, bond can be classified. Based on seniority, bond assures that the bondholder must get priority in sharing profit distribution. In general term, seniority indicates preference in position over other lenders, and debts are sometimes labeled as senior or junior to indicate seniority. Some debt is subordinated, as in, for example, a subordinated debenture. In the event of default, holders of subordinated debt must give preference to other specified creditors. Usually, this means that the subordinated lender will be paid off only after the specified creditors have been compensated. When you will invest in the bond, you must know some bond ratings. Based on the bond ratings, you can identify whether the bond is secured or unsecured. We can see the high grade bonds is mentioned as Moody's AAA, S&P AAA, which means capacity to pay is extremely strong. And medium grade is Moody's A, S&P A, Moody's Baa, S&P triple B. It is about capacity to pay is strong but more susceptible to changes in circumstances. And low grade and very low grade bond is so risky for the investor. Here, the possibility of repayment is very low. Moody's BA and Moody's B is the low grade bond, and Moody's C and S&P C is the very low grade bond. We already learned that government can also issue bonds for their fund raising requirement. Government bond can be issued by the local government. Government bond can be issued by the national government based on their requirement. For development activities, government generally issue bonds to the public for their long-term fund requirement. The government bond or treasury security are the most secured bond instrument. So investors generally prefer to invest in government bonds rather than corporate bond. Zero coupon bonds make no periodic interest payment. The entire yield to maturity comes from the difference between the purchase price and the par value. If your bond price is 900 and your par value is 1000, The difference between par value and bond price is 100. So only this 100 is the capital gain from the zero coupon bonds. No interest payment, no coupon payments will be paid to the investor. Zero coupon bonds cannot sell for more than par value. Sometimes called zeros, deep discount bonds, or original issue discount bonds. Treasury bills and principal only treasury strips are good example of zeros. How does a zero coupon bond work? The price of a zero coupon bond can be calculated by using the below formula, which is P equal to M divided by 1 plus R N power N. P is the price, M is the maturity value, R is the investor required return, N is the number of years. If you want to purchase a company ABC zero coupon bond that has a face value $1,000, so here face value is $1,000, and maturity period is 6 years, and you'd like to earn 5% per year on the investment. Using the formula, you might be willing to pay 746.22. So using the formula, your M maturity value is or face value is $1,000, and your R required return is 5%. So 1 plus R, 1 plus 0.05 power your maturity period 6. So your zero coupon bond price is 746.22. So this way we can find out zero coupon bond. Floating rate bond. In floating rate bonds, coupon rate floats depending on some index value. In floating rate bonds, there may have a collar, a ceiling between this collar or ceiling. The price exists. It cannot move beyond or lower the ceiling value. Other bond types. Catastrophe bonds issued by property and casualty companies. Here, pay interest and principal as usual unless claim reach a certain threshold for a single disaster. At that point, bondholder may lose all remaining payments. In catastrophe bond, investor can expect higher required return. In income bond, coupon payments depend on level of corporate income. If earnings are not enough to cover the interest payment, it is not owed. In income bond, investor can also expect higher required return. Convertible bonds can be converted into shares of common stock at the bondholder's discretion. Here, required return is low. Put bond. Bondholders can force the company to buy the bond back prior to maturity. Here, required return is also low. Bond market. Like stock market, there is also bond market, which is both primary and secondary. For first time issuing a bond, the bond is transacted in the primary market, and secondary bond are transacted in the secondary market. Bond markets are very vast, very larger than stock market. Bond are transacted both in regulated market and unregulated market. Unregulated market like over-the-counter market. The reason behind the bond market is very larger than stock market is that we know that the municipal authority, every state, every local government, national government need funds every day for their state operations running on, for their development activities. So for this reason, if you can imagine how much capital is needed by a state, a local government, a country to run their country, to run their state. So in this sense, the bond markets are bigger than stock market.